think we can partially separate domestic liquidity from international liquidity because those are not exactly the same thing. And one thing I'll touch on about the whole inflation hedge thing before I continue answering that question is that, so part of my work is I track money supply growth quite a bit in different countries. And one thing you generally see is that Bitcoin has been historically very correlated with money supply growth, especially when you take global M2, so global broad money supply, and you translate it all back into dollars. And so the two big components there are, one, are a lot of countries printing money, and two, how is the dollar performing relative to those other big currencies, right? The euro, the UN, yen, all these kind of major currencies. And generally, when that's rising very quickly, especially in rate of change terms, that's usually historically coinciding with the last 3 Bitcoin bull runs. And when that starts kind of rolling over and consolidating, that's when Bitcoin has also historically kind of consolidated. And inflation historically comes somewhat after money supply growth. It's basically a side effect that happens on a lag. And so when people, the inflation that people saw taking shape in 2022 is in large part a result of actions that happened over 2020 and 2021. And so, for example, someone did buy Bitcoin well ahead of that. If they were anticipating inflation, if they, saw that, this kind of fiscal stimulus and money supply growth was happening, if they purchased Bitcoin, it did, protect them against the ravages of those inflation, just not perfectly timed with CPI that they see. So that's one thing I'll kind of point out. Because now we're in the 2022 is the phase of the Fed fighting back on some of the things that happened in 2020, 2021. And then going back to the idea of liquidity, basically, domestic liquidity indicators, there's been a popular ratio that I've seen floated around and I've incorporated into my own analysis. I used to do similar ways of adding it together, and I like this one a lot, so I incorporated it, which is basically you take the Fed balance sheet, and then you also take the Treasury's general account, because they have basically a cash account at the Fed, and any money in there is essentially dead money, right? So when that's growing, it's actually sucking money out of the system, and when that's shrinking, they're putting money back into the system. And so when you kind of take those together and you add things like reverse repos, you can get a liquidity measure that is actually rather correlated with risk assets in the United States. And when you look at a global liquidity indicator, in recent years, the dollar index is probably about as good as you're going to get, or dollar denominated global money supply. And that's because so many countries in the world have dollar denominated debts, right? The dollar is for the most part the unit of account for the world. That's changing somewhat over time, but most commodities are priced globally in dollars. Most international trade is denominated in dollars, and there's $13 trillion in dollar-denominated debt outstanding in the world. A lot of developing countries, when they borrow from international sources, it's done with dollars, and it's not even lent by Americans. Usually, it's usually Europeans, Japanese, Chinese. These, even though they're denominated in dollars, the lenders are all around the world because it's the global reserve currency. And so when you have the dollar strengthening relative to a basket of other currencies, essentially their liabilities are hardening compared to their cash flows. And vice versa, when the dollar is weakening, essentially their debts are getting devalued relative to their other currency cash flows. And so especially when that changes in a very kind of short period of time, like when it strengthens or weakens very rapidly, that can cause a liquidity squeeze or a liquidity loosening. So those are kind of some of the things I look at either domestically or internationally when talking about liquidity, which is already kind of a jargony topic to begin with. It was so funny that I had to share it just because it's one of those like long-term projections. It's like comical. Yeah. And basically their whole point was showing that if there's no changes made to the current kind of fiscal situation in the United States, that debt as a percentage of GDP will balloon comically in the decades ahead with really no end in sight. And I guess a scary thing about that chart is that assumes like no problems. That's kind of like no recessions, no wars, no XYZ. That's just kind of like business as usual if nothing's fixed. Of course, it can't actually end up looking like that because you'd run out of base dollars to support that. You'd eventually would have to print the difference, and therefore you'd have a rapid growth in nominal GDP, which would mostly be the inflation component, and it would be a lot messier than that in real life, which is kind of why I kind of picked fun at them for publishing that chart.
Yeah.
I've done actually similar analysis to what Parker just described, which is, kind of looking at ratios of either money supply, like broad money supply to base money, or total debt to base money. And so you can plot them over time. And we did hit a peak back in around the global financial crisis. It was something like 60 to 1. I think his chart showed 52 trillion to less than $1 trillion. if you kind of do the numbers, it was like 60 or 65 to 1 ratio. And the last time we hit a super high ratio was actually 1929, like the early 1930s, before there was all sorts of like monetization then. And you kind of had this big echo happen ever since the global financial crisis, where we've been increasing the monetary base to try to catch up with that broader setup. And the 13 trillion I mentioned was specifically the offshore dollar-denominated debt. So that's like debt that'd be owed by entities, either governments or corporations in places like Turkey, Brazil, China, countries around the world that use dollars. And the challenging thing here is that both assets and liabilities in many cases are denominated in dollars. So in the United States, for example, we have $100 or $200 trillion in total assets. That includes real estate, stocks, bonds, things like that. Even if you just factor out the debt, you have basically real estate and stocks. That's on a pretty small monetary base, and then you have all those liabilities, and so it's kind of this like, that's why you get these like liquidity crunches when they try to do things like pull dollars out of the system, or if there's any sort of shock to income while all of these assets and liabilities are highly levered compared to the monetary base. And you see a similar effect when you look globally. And essentially what we're seeing now with that chart you brought up is just that right now the US is on this very unsustainable fiscal path where they're running very, very large deficits. And historically, the way you deal with that is you kind of monetize it. If you're an emerging market and you owe debt that you can't print, like if you're Argentina and you owe dollars, you just kind of have to default or ask for like a restructuring. Whereas if the liabilities are in your own currency, like if you're America with dollars, if you're Japan with yen, you essentially print the difference, but that leads to inflation. You're inflating away part of the debt. And right now, they're kind of in that counter push where they're kind of trying to get the wheels back on the cart. They're kind of trying to say, no, this is sustainable. We're going to get back to like financial discipline. And it's one of those things. If you do the math and you do somehow conclude that they can do it, if you think, okay, they can return to structurally positive real yields, they can get this under control. They're going to do all sorts of fiscal adjustments to get the debt under control. They're going to start paying it down. Then that's a good case to buy and own dollars long term. On the other hand, if you do the math and you kind of realize that this is almost certainly unsustainable and that almost any attempts that they try to change the system will probably cause a problem elsewhere in the system and continue the kind of the perpetual debt increase and more rounds of quantitative easing and long stretches of negative real yields on all these various bank accounts and debt instruments, then that's a case to buy, like sound money. Historically that could have been gold. Of course, this is a Bitcoin show. Bitcoin is the fastest horse in town, better in many ways compared to gold. And so essentially that's kind of the case to buy those harder monies if you view them as more sound than what you're probably going to get with the U.S. financial system, let alone when you do kind of a similar analysis on other countries around the world and their debt issues.